Come on in, David. Get in here. And I want to talk to you about this fear of inflation. We were in Richmond yesterday with Jeff Lacker. The fear of inflation out there. Is it an academic exercise, or should our viewers be afraid of inflation out there?
Tom, my personal opinion is yes, you should be concerned about inflation, and I think there are a couple of reasons for this. Number one, I think what we're seeing in terms of inflationary pressure among emerging market countries, I think is real. Because the reason why inflation is picking up in China is probably a reflection of the disappearing surplus labor in China, which has kept global inflation very low for the last 10 years.
Right. It's been a gift. It's been a gift. It's
about a gift, exactly. But now that the surplus labor is shrinking, disappearing altogether, what you're seeing is a deterioration in the in the inflation growth trade-off. Also, the rise of Chinese consumers. You know what? It's very inflationary because they happen to basically consume very little commodities right now. And as they basically consume more, guess what? There's going to be that much commodities go around. That's going to be inflationary.
We're gonna get through this, folks, with some economics, but I really want to take advantage of David Wu's expertise in foreign exchanges here. Let's bring up this chart, and we want to talk about reserves. You can see it down here, David, in the monitor. This is a boring chart to start out with. A more diversified global reserves. So we go up, and there's a crisis, and the reserves come down, and they've really come right back with good economic growth. Give us a clinic here. That basket, that bushel basket, the reserves is money sitting around at banks, right?
Sure. I mean, these are reserves essentially held by central banks, especially among the emerging market economies. Essentially, this mainly reflect essentially the renewed capital inflows into emerging markets. That which was a very obviously a very attractive investment theme last year. That has been a major reason. But what's happened recently, actually, in the last couple of months, as you know, we've seen actually outflow from emerging markets, as investors have been essentially spooked by the inflationary outlook. Possibly the central banks may over-tighten. We've seen actually a little bit of outflows, and that generally, believe it or not, has been dollar supportive because we've seen actually less euro buying.
Break exclusive, and this is the most important educational note of the hour. Is foreign exchange about real interest rates, short-term interest rates, or is it about flows?
I mean, flows follow returns. So from that point of view, and generally flows follow real returns, expected real returns. So from that point of view, there's no doubt. And I think, what's interesting, however, is that recently real yields on U.S. inflation index securities have gone up a lot. 10-year, real yields gone from 0.4 to 1.4 right now in the space of 3 months, and yet the dollar hasn't really benefited.
Why?
That is interesting because investors are very concerned about the fiscal outlook in the U.S.
Stop. We're going to explain this again. This is so important, folks. There's so much misinformation about this. Start over again. Inflation yields have gone from 0.4 up. On a percentage basis, they ballooned.
That's right. So real yields on 10-year U.S. tips has gone from 0.4% a few months ago, just after QE2, to now 1.4%.
Dollar should strengthen because the global roulette wheel wants to come to the dollar to capture that yield.
Exactly. And yet the dollar has failed to strengthen on the back of this repricing of real yields. And the reason, I think, it's because the rising real yields has to do with basically, the fact that, people realize that we're stimulating growth at home only through running a bigger budget deficit. So for the dollar, not only the quantity of growth matters, but the quality of growth is even more important. And people realize the only reason why the U.S. is going to be growing 4% this quarter possibly is because, another wave of big stimulus package. And that cannot be good for the dollar.
Let's look at this chart. This is great. We're going to play this off Fred Bergson's work on the FT today. David Wu, here's U.S. reserves as a percent of the global pot. Take the bushel basket. How much in there is yen, euro reserves? I would say there's a persistency to that chart. Are you linking that persistency to a lack of confidence in our fiscal affairs?
No, there's no doubt. There's no doubt. I mean, what we've actually looked at, I've looked at this quite closely. Over the last 40 years.
Excuse me, full disclosure, folks, let's interrupt Dr. Wu. I actually read the research, and I know David's one of the best people out there about this, so I'm setting up the questions. Go.
No, I think, frankly speaking, if you think about this, the U.S. is going to be the only major economy that will not see an improvement of its underlying fiscal position this year. I mean, U.S. budget deficit is going to go from 9% of GDP last year to more than 10% this year, whereas Europe, in contrast, is going to go down to 4.5% from basically over 6.5% last year. And history tells us that relative fiscal policy matters a great deal. Just a 1 percentage point improvement of Euro's underlying budget balance can give a 7% appreciation of the euro against the dollar.
Yeah, here's Fred Bergston in the FT today. I don't know if you saw this, David. This is a great piece, whether you agree with Dr. Bergston or not. The Peterson Institute, which he has really done a great job with, why the world needs 3 global currencies. It's on the edge of Eichengreen. The international monetary system is already becoming bipolar. It may soon be tripolar. I'm suggesting there, David, renminbi, euro, dollar. The U.S. should accept this and even promote its acceleration. What should be the administration's response to 26% of the pool is euro and the renminbi coming along presumed in 10 years?
There's not much the administration can do. I think at the end of the day, it's really up to China to what extent they want to accelerate the internationalization of the renminbi. Right now, the problem is, it's not that easy to buy renminbi if you're not a Chinese domestic. So from that point of view, and then the question is whether China is prepared to allow its currency to appreciate, because that's going to be the price that they'll have to pay for allowing renminbi to become an international reserve currency. And right now, I don't think there's a very compelling reason to think that the Chinese this year all of a sudden is going to accelerate the path of renminbi appreciation.
Barry Eichengreen's new book, Exorbitant Privilege. Folks, I used it as a read this. Great book. Thrilled to have Dr. Eichengreen on with us. The exorbitant privilege. Valerie, you started just saying this idea of what a privilege to have a reserve. Can we still have a privilege if it's Bergston's tripolar world?
Obviously, probably not. There's no doubt. I mean, I think, from that point of view, that's the problem. That's a double-edged sword for the U.S. You want a weaker dollar. You want renminbi to basically to share the pain of the dollar adjustment. But at the same time, the Obama administration wants to continue to enjoy very low borrowing interest rates, on funding a very, very large deficit. If it had been any other country whose currency is not an international reserve currency, the funding costs would have gone through the roof by now.
David, I want to talk about yen. We're going to bring it up here right now. Dollar weak or yen strong. This is that asymmetrical relationship of every pair. We go strong dollar, weak yen. I mean, explain this idea that when you have a currency pair, whatever it is, there's always one sort of in charge.
Yeah. I think in this case it's basically dollar weakness rather than yen strength, because all that's been going on in the last 2 years is about the convergence of the U.S. to Japan. Right? If you think about this, Japan used to have very large budget deficit. Now the U.S. got very large deficit. Okay, used to be the case that Japan had 0 interest rates. Now U.S. got 0 interest rate. Used to be a case that the Bank of Japan was printing money. Now the Fed is printing money. So from that point of view, the foreign exchange market is expressing this convergence between U.S. and Japan. And when you go to Japan, by the way, all my clients tell me we know which way U.S. is going because we've had 10 years of lost decade. We think that this is what is in store for the U.S.
So how's it going to go? Are we going to have a lost decade? Are we going to have a lost 5 years?
I think there's a very good chance. I think people don't really understand to what extent this recovery has been so dependent on fiscal stimulus, on monetary stimulus, that will not be sustainable over time. So from that point of view, there will be a price that we have to pay. It's just a question of when, and probably it's going to come sooner rather than later.
Can markets clear themselves, whether it's Fannie, Freddie, or just the general housing market? If we clear those markets, if we have the courage of our convictions to clear those markets, can't we move on to a better prosperity?
Well, we'll see. I mean, obviously, market clearing will take time. The problem is that we may not have that much time. QE2 is going to come to an end by the end of June. So basically, that means the bond market will have to find an extra $800 billion in the second half of the year to fund the U.S. basically, government funding gap. At the same time, now finally Washington is fighting the battle over the outlook for fiscal policy. Certainly, the room for further loosening of fiscal policy is going to be much more limited. So policy is going to become less supportive than has been the case over the last 2.5 years.
Let's look at a chart that we used to look at a lot. This is a current account deficit. And you can see it's a zero line at the top with a deficit all down there. And you can see the rollover. And there's a crisis-induced recovery. Why was that, David? Why do we get that hockey stick there? Was that, which part, exports or imports, helped out there?
No, it was mainly imports. I mean, U.S. current accounts driven primarily by imports.
We stopped buying imports.
Exactly. So during the crisis period, recessionary period, imports collapsed. Therefore, you saw a big improvement in the current account.
But now they come back.
Exactly. Now it's come back. Also, obviously, oil prices more than double, since 2008. That has been another contributing factor.
I mean, do we just assume it's going to revert back to the gloom of a couple of years ago, or is there a new, better normal for our flows with our trading partners?
I think in this particular case, I mean, U.S. export ultimately still is not growing that fast. If you look at Germany versus the U.S., for example, Germany now is selling basically almost 4 times, 5 times more cars in China than is the U.S. And whereas 10 years ago they were selling almost the same number of cars. So there's no question the U.S. manufacturing sector simply doesn't have the competitiveness for us to basically grow and export quickly.
Just on time, I want to look at this chart, David. You've written about this. Don't worry about China. Here's food inflation in China, the yellow line. We've shown this a number of times. I go back to Connolly's great quote from years ago: China's inflation, it's our problem. It's our inflation. Is that true?
I think that's probably more true than not. I think from that point of view, I mean, listen, Chinese inflation going up, that simply means imported inflation is going to be going higher. That means other countries are going to have also more pricing power as a result. It's going to be a global event. There's no doubt. The point here is that real interest rates globally in the next 10 years are probably going to be a lot higher than they've been in the last 10 years because of Chinese inflation.